So Vanguard's chief investment officer is now recommending a pretty stark departure from a traditional asset allocation. Recently, he spoke with a reporter from Fortune and has commented on the state of US equities right now. If you're unfamiliar, Vanguard is an investment management company that provides a lot of low cost mutual funds and ETFs. In the last few decades, they've become pretty much the dominant player in sort of these funds. Their success, as I see it, has come largely from their philosophy. So Vanguard generally seeks to match the performance of different indices. So their philosophy is that active management doesn't oftentimes outperform index funds when you account for fees. So they're really about cost efficiency over anything else and passive management. And if you've seen any of my videos before, you know I'm a huge proponent of Vanguard. There's so many different investment management companies out there that, to simplify things, oftentimes I just try to find someone who I believe in their philosophy. That way I don't have to inspect every single fund that they have. I can just sort of rely on the fact that they have a North Star that I agree with. And for Vanguard, that North Star is passive investing at a low cost. Additionally, Vanguard, like a lot of sort of values and fundamentals investors, believes in some amount of diversification. However, the big thing that came out of this meeting with Fortune was that the president and the chief investment officer of Vanguard Group has said that US equities are basically going to experience lower levels of return than they have in the past. And this is because they're basically coming off a really hot run. And the big takeaway from this article that I took was a real reversal in the asset allocation. And this is pretty staggering, in my opinion, because traditionally people see a portfolio that's devised of like 60% stocks and 40% bonds. That's a pretty standard portfolio. But I would argue that it's even gone up higher than that to 80-20. But he's actually arguing that we should flip that now. He's basically saying to go with 60% bonds and 40% stocks, sort of on the whole. He also brings in that non-US equities are fairly valued. So, he's suggesting that you might do some sort of split between your equities portion as like some US equity, half US equities and half international equities, but that you're still allocating a huge amount to fixed income. And this sort of goes against a lot of what I've been taught over the long haul. A few things, obviously, that like my immediate jerk reactions to this is that it's really tough to miss out on like the best moments of the market, and you can never predict that. Swinging way that far to bonds really scares me that you might miss out on sort of like the upswings in the market. That said, he's entirely right that the US equity market, especially large cap stocks, has done just incredibly well, way above their historical averages. And so with that, there is the sense that there probably will be some amount of correction. And that might be that it just doesn't grow as much as it has in the past few years. It might not be that there's a total negative year, but that you're not going to see as such stellar returns, because if we look, I just made a chart really quickly that tracks the yearly returns of different asset classes. And if we're looking at the S&P 500, you can see that for the past 5 years, besides 2022, which was a big down year, you've had some really stellar years. We're talking about, so 2024, it was up 25%, 2023, it was up 26%, 2021, it was up 28%, 2020, it was up almost 19%, and then 2019, it was up 31%. So yeah, in the last half a decade, we're seeing really stellar annual returns way above the normal. So if you look at the past 5 years, the average annual return was about 16% for the S&P 500. But if you look over the last 30 years, you're really only at about 12.5%. So you can see that the last 5 years have outperformed historical records for the S&P 500 by about 4%. Um, Whereas, if we look at some other asset classes, we can see that they're either underperforming or they're not by overperforming by as much in the last 5 years as they were in the last 30 years. So again, whereas I might not fully believe in totally rotating out of U.S. stocks to such a degree that Vanguard is suggesting. I will say that rotating away from large cap stocks does seem to be a strategic and tactical move at the moment. Again, you're just looking for ways to diversify against any downturns in a specific asset class. If we look at sort of mid cap and small cap stocks, there is some opportunity there because they haven't gone up by as much as large cap stocks have. So if we look at mid cap, the last 5 year average return is about 10.5%, whereas like over the 30 years, it's 13.2%. So, it's sort of underperforming in the most recent few years than it typically does over the long haul. And the same goes for small cap, which, over the 30-year period is about 10.6% versus 8.56% in the 5 years. So again, we're underperforming our sort of like longer term record. Again, this sort of holds true for both developed Europe and developed Asia. Europe, traditionally performs about a little over 8%, whereas right now it's just under 6% over the last 5 years. Asia, a little like less so. Over the 30-year, it's usually up about 3.5% on average. And over the 5 year, it's up less than 3%. So, some opportunities there. Europe seems like a bit more of an opportunity than Asia. But still internationally, we're seeing recently that those stocks have not been performing as well as they historically have, and that could just be a signal that we need to rotate into them. Again, no single asset class can go on forever outperforming every other asset class. There will just be moments where they pull back, and so emerging markets. If we look there, we can see it's really outperformed over the 30-year versus this recent 5 year period. So over the last 5 years, it's only performed about 3% annually on average. Whereas over the 30-year period, the average annual return is about 9.3%. See, typically, like you would expect to have like higher returns in emerging markets because you're taking on a higher risk. And those companies have a lot more room for growth. That said, growth has been driven so much by AI in the large cap US space that has been such a source of growth over the last 5 years that's what's really outpacing all those other traditionally higher growth markets. And then again, over the 30 years, if we look sort of at another asset class, which is bonds, we can see that US bonds typically hover a little under 5% over the 30-year period. But really over the last 5 years, it's barely up. It's only at 0.5% on average. And same thing with international bonds. Actually, it's down over the last 5 years by 3%, whereas typically over the 30-year period, we're up 4%. So, to the point that we should be moving into bonds, it's actually, founded in the sense of just like pure returns, like that there is a recent lag behind what it traditionally does. If we're looking purely at performance. So, the move to some amount more bonds, actually, it feels right. Going all the way to, 60% bonds feels like a big move. Unless you're really accounting for some pretty stark downturns in the equity markets. But, that move to diversify is well-founded, I think. Finally, I looked at commodities, which, is a real place where you can get diversification in your portfolio. And I just, again, looked at the 5 year versus the 30-year. And, over the 5 year, actually, commodities are up a little under 10%, whereas over the 30-year, it's up about 5.5% on average. So, commodities is a place that um, has done actually better in the last few years because in 2021 it was up almost 40%, and then in 2022 it was up 24.8%. So again, there's been a lot of talk around the US dollar getting hit really hard recently, and gold and silver being a way to protect against that. Inflation is also a huge concern, or has been, though it's coming down. And gold and silver and commodities can help as inflation protection. Um, so less than like a rotational play, I would say that commodities work as a diversification play more than anything. And again, taking in some macro trends right now, seeing that the US dollar is doing poorly, having some gold and silver in your portfolio can really help as you keep up with inflation and your purchasing power. Obviously, it's hard to say when the momentum will end around these sort of large cap US stocks, especially in the tech space. But a few things that I've been thinking about recently, which I've sort of talked about in other videos, is that there's just a few red flags maybe to be aware of as people consider what to invest in the coming months and the coming years. And the first thing which I've talked about is just this concentration risk. If you've been in U.S. equities, you're really probably focused on the S&P 500. And if you're in the S&P 500, you're really focused on the sort of top 10 companies, which are all so heavily invested in the AI space. So again, if you've just been holding it there and not rebalancing over time, your portfolio has probably gotten to be a large portion of A, US equity, but B, large cap tech stocks. So again, the idea that you're getting a broad diversification is sort of like a little less sturdy anymore if you're just invested in the S&P 500. Secondly, yes, if you've sort of just like haven't been rebalancing over time, your portfolio probably has gotten a little out of whack. So if you haven't been rigorous in your rebalancing strategy, you've probably allowed your U.S. equities to just increase over time. The other big thing is just valuations are so high in that space. If you look, you'll just see that like in even like the large cap growth space, you're looking at really high PEs of like 40 on average across just like these ETFs. Whereas you're getting more relatively low valuations in international markets. You're looking at under 20 PE ratios, really closer to like 15 for some of these, on average, these ETFs in the international space. The US has been politically and economically in a state of uncertainty. I don't think that anyone, regardless of how you feel about leadership right now, like good or bad, there is volatility that comes with having politicians who are basically making choices on whims. And with the passage of the new bill, we're going to see a huge increase in the deficit. And likely the US is going to have to print more money to cover its expenses. Because it certainly has not been able, with this new bill, to bring down expenses by as much as tax cuts have raised costs. So that just means that the value of your dollar is just going to go down more. So in this environment, migrating away from U.S. stocks on a macro trend level, on a valuation level, and just on sort of like a rotational level does seem right. And again, this is not to say that you should move all the way to what Vanguard is suggesting here, because that would be a pretty stark change to your portfolio. But certainly, I am starting to think about rotating into undervalued stocks, and even rotating into bonds, which traditionally I don't even consider, because I highly prioritize growth over consistent income. But for full disclosure, a few of the funds that I'm looking at investing in the near term are the Vanguard European Stock Index Fund, which is VGK. That's the ETF. Um, Again, I'm seeing a lot more opportunity in European equities than I am in US equities. So rotating toward Europe, I think, is a good plan, just because Europe has lagged behind the US in the last 5 years. I'm also looking at the Vanguard Energy Fund, VDE, which has underperformed recently. Again, this is, I consider, a part of your inflation protection. So it's not exactly commodities, but it does live in the commodity space because it's energy. Um, I'm also looking at Vanguard's Pacific Stock Index Fund, VPL, which, again, is focused on developed international markets. This is also underperformed relative to its longer term history. On the US front, I am looking closer at both the Vanguard small cap and mid cap value ETFs. I think these are well priced, the valuations are lower, and I think that they have more room for growth. They've really underperformed over the shorter term history than they have over sort of a 30-year period. And valuations are reasonable in that space still in the US market. Um, and then I've also been looking at Vanguard's Global ex-US REIT Fund, which is VNQI. And this again is trading at sort of like lower PEs, offers like strong dividends, is giving international exposure. So, I'm considering, hedging against the US dollar by going abroad to other economies. I'm also still continuing to invest in both silver and gold through SIVR for silver and IAU for gold. There are obviously other options out there, but those are sort of the ones that I've been thinking about investing in. And lastly, I'm looking at sort of like a total international bond index fund. Not sure exactly how much I'm going to put into it, but I might start sort of allocating some amount of money into BNDX, which is Vanguard's international bond indexed ETF. I'm going to continue to stay as heavily invested in equities as much as possible, but I will begin to rotate into small cap and mid cap US stocks and then international stocks, as well as a few sector ETFs. On top of that, I'm just going to try to probably balance out with a little bit of international bonds. But for me, I don't know when the momentum on US tech stocks is going to end. But certainly it will end at some point. It simply can't keep up at that rate forever. So the question is, how much do you move over to these other places? And for me, I'm continuing to maintain my allocations in those spaces, but any new money that's coming into my portfolio, I won't be allocating to the S&P 500, but I will be moving into equities still as well. So, I think what Vanguard said, has merits. For me, I'm not as comfortable moving so much into bonds as they're saying. Time will tell whether that was the right strategy over the next couple of years. I certainly feel like we're due for a rotation. So my feeling is that we should rotate into some of these undervalued spaces. I hope this was helpful. This is just what I'm thinking right now. Feel free to drop what you're thinking asset class wise into the comments. But as always, I think as long as you're investing in the market with passively managed low cost ETFs, you probably will do fine in the long run.